We are quickly approaching the end of the year, which means you're running out of time to do real tax planning. So in today's video, I'm going to walk you through over 20 different tax planning moves that you can make as a high income business owner. The first one is to max out the employee side of your 401k, solo 401k, etc. You can do $23,000 in 2024. You still have room to get this done. Two is to max out the employer side of those retirement plans. So let's say you're a solo business owner, you have a solo 401k, you can get up to $69,000 in per year as long as you have enough earned income. So if you're an S Corp, you'd need to make basically over $185,000. If you're a sole prop, then you basically have to have enough profit where 20% of the profit gets you to $69,000. If you don't have enough earned income, but you have enough earned income above $69,000, then you could do the mega backdoor Roth 401k through it. If you are not a solo business owner, well, there's a match that you have set up, but you also can do a profit share. You can do a profit share for all of your employees. You can either say, hey, I make this much, they make this much, and it can be percentage based on how much you make relative to them, or you can do it equally between you and your employees. The next one is to max out your backdoor Roth IRA. For those that don't know, if you make too much money, which is basically above $240,000, you cannot directly contribute to a Roth IRA. This is where the backdoor Roth comes into play. You put money into an IRA, it's non-deductible, you don't deduct it, you make too much money to do this, and then you convert it over to Roth. You just need to make sure you have no money in SEP IRAs, traditional IRAs, simple IRAs, because if you do, and those are pre-taxed, then it triggers the pro rata rule and part of this would become taxable. The next one is to max out your HSA if you have it. Basically, you have to have a high deductible health plan. As long as you have it, then you can do $8,300 if it's a family plan, $4,150 if it's just you. Ideally, you do this through payroll, because if you do it through payroll, it's pre-FICA tax, pre-Fed, pre-state. If you don't do it through payroll, then it's just pre-Fed, pre-state. And at the end of the day, for any high income earner, not a big deal, because once you cross $168,800 in income, you no longer pay self-employment taxes. You just have to pay 2.9% additional Medicare tax. So you're just missing out on that additional 2.9% versus somebody who makes under that is actually missing out on the full 15.3 as somebody who's self-employed. The next one is to maximize the qualified business income deduction. So if you're an S Corp and you make over $483,000 a year, like pretty much all of my clients, the qualified business income deduction is either the lesser of 50% of W-2 wages or 20% of business profits. This is if you're not a service-based business. If you're a service-based business, like a lawyer, like a financial advisor, anybody who basically they work with you because of your name, image, and likeness, then you don't qualify. If you do qualify though, you need to fine tune this. You want to get the 50% of W-2 wages and 20% of business profits as equal as possible to max out that deduction. Sometimes this isn't possible. Maybe you have too much in wages. Maybe your profit is a little bit too low. Maybe you would have to put your reasonable salary way too low, which is no longer reasonable, but you want to do this to the best of your ability. The next one is to utilize 529 plans. So if you have kids and you want to save for college, some states have a tax deduction. Some states like Indiana have a tax credit. You want to take advantage of this, and then you also get the tax-free growth and tax-free use on college. You just want to see what's that max deduction in the state. Sometimes if you put in too much, then it'll carry forward to future years. In other states, it doesn't carry forward. That's a rule that you really want to make sure you understand. You also now want to review the entity structure. So it's a little too late to make many changes to the entity, but you want to think about this for next year. Maybe you're a partnership and you really should be an S Corp. Maybe you're an S Corp and you really should be a C Corp because of QSBS. Maybe you're a C Corp and you have high profits and you're distributing all of it in an S Corp would make sense. You really want to take some time and think about it and make sure that you are in the right entity. The next one is to just look at your books. Time and time again, I meet with people and I realize that their books are totally screwed up. They're not communicating with their bookkeeper. They're maybe investing or doing other things for personal straight through their business. Definitely don't want to do that. Even though it's okay if you're a sole business owner, it just creates complexities and issues, and it puts a lot more communication on you for having to talk to your bookkeeper about, oh wait, that's personal, or oh wait, that shouldn't be considered this. But you want to review your books. You want to make sure all the expenses are on it. If you maybe bought some things for the business and the personal, you want to make sure that you get all that in there and you get to maximize all those deductions. The next one is to just consider PTET. So what many people don't know is you can only deduct $10,000 of state and local taxes on your federal tax return. A lot of my clients are paying hundreds of thousands of dollars in state taxes. And so what PTET does is it allows you to pay a portion of those state taxes through the business, which allows you to sidestep that $10,000 deduction and get a lot higher. I have clients who are deducting $200,000, $300,000, $400,000 through PTET, which is saving them a ton of money on taxes. If you have not elected into it this year, look at your state and see if it's still able to be done. If not, think about this for next year and bring it up to your tax team. You also want to consider accelerating expenses. So maybe you have some expenses that you know you're going to have in Q1 of next year. You could end up paying for those in this year to reduce profit and reduce your taxable income. You also can accelerate or defer income. If you know income is going to be coming in January, it's a lot, you could ask to be paid in December, or if it's going to come in December, you could ask them to pay in January, so you can kind of push back when that income comes in and defer those taxes to a year later. The next one is to use your FSA fund. If you don't have an HSA, a lot of times you have an FSA. That's just a spending account for health expenses. So you want to look at this. If you still have $500, $1,000, $2,000 left in this FSA, you need to see how much is to use it or lose it. Some you can't carry any forward. Some you could potentially carry 1,000 forward. You don't want to waste these dollars. So maybe you need to go buy contacts for next year, or go buy some glasses, or go do some dental work. Whatever it is, make sure you're spending that money. There's also a lot of websites out there that will help walk you through all the different products and food and other things that are FSA eligible that you could use it on. The next one is tax loss harvesting. So year end is a really great time to go look at your investments and say, do I have any investments at a loss? If so, should I tax loss harvest, grab that loss and reinvest? But make sure you don't grab that loss and rebuy back that same investment within 31 days, because that creates a wash sale and you don't end up getting that tax loss. You'll end up wanting to reinvest in other areas or something that's correlated and going to follow that investment. Then on the flip side, you also might want to do some tax gain harvesting. Maybe you have losses you've used this year. You want to tax gain harvest and raise that cost basis of your investments. Year end is a really great time to do that. The next one is Roth conversion. Let's say that this year ended up being a lower income year than you expected. Your business didn't do as well, or maybe you just started your business and you are in 10% tax bracket, or 0 or 12. What you could look into is saying, should I do some Roth conversions, which means converting pre-tax money to Roth. So what ends up happening is you're moving money over to Roth. That counts as income, so you're filling up different tax brackets. And so if you're in a lower tax bracket than you've really ever been in before, or than you expect to be in retirement, doing Roth conversions today can make a lot of sense. Quick tip, make sure you save cash to pay for the taxes. If you withhold for taxes, you will pay a 10% penalty for an early distribution. The next one is to review your withholding and estimated taxes. For a lot of business owners, they don't know where the business is going to end up. And so they end up not paying enough in quarterly taxes. You want to take a look at this and say, what am I going to owe? Do I need to pay a quarterly tax now? Do I need to pay a Jan 15th quarterly tax? Should I run a large payroll and withhold a ton of it to make sure I avoid those penalties? Great tax planning means that you should be checking at the beginning of the year, middle of the year, and end of year on this, because time and time again, I see people have large penalties for underpaying taxes, and this is something that you should not be wasting money on. 18 is to donate cash to charity. At the end of the year is a really great time to say, hey, we have extra money, we've done really well, I want to give to charity. How much should I give? So donating cash is one good option. The better option is to donate stock to charity. So when you donate cash, you just get this deduction against your income. When you donate stock or crypto or any investment that's grown, you avoid that capital gain and you get a deduction against your income. So what you could do is, instead of using that cash, you buy back that investment and you raise that cost basis. Now you moved it to a donor advised fund. You can give to charity now, you can invest it and wait, but because you donated before selling that investment, you avoid that capital gains tax as well. The next one is to do a cost segregation study on your properties. So maybe you have a bunch of rentals and you're cash flowing a lot, and this year you bought a couple more. You can bonus depreciate through a cost segregation study and offset some of that gain. You have this big passive loss over here that can offset this passive gain over here. For people who are real estate professionals or get the short-term rental loophole, you can actually use these losses to offset active income, but you have to make sure you hit the material participation tests. This one is all about qualified opportunity zones. So maybe this year you sold a business, or maybe you had a huge capital gain from crypto or some stocks that you invested in. What you can do is you can defer that capital gain through 2026 by reinvesting those proceeds into a qualified opportunity zone. Then, as long as you hold that investment for 10 years, the entire growth on that is tax-free. This can be a really great tool. You just want to make sure that you're not just doing this for taxes, that it's truly an investment that you believe in that's going to grow. Because if you give up all of the growth and it has really no growth, then you might have been better to pay the taxes and reinvest elsewhere. Okay, the next one's to prepay property taxes. You could choose to prepay your property taxes early, so that way that could flow through to you and be another deduction. This isn't as big of a needle mover, but it is something to consider. And then the last one is to use the annual gifting limit. So let's say you're a high net worth person, you've been giving to family, or you want to give to family, you can give $18,000 a year per person. So husband and wife or married couple can give to each kid $36,000. If they're married, $72,000. If there's kids below that, you can give, again, $36,000 to each kid. This is a really great way to be not using your exemption, but passing on wealth to your kids and your family. A lot of people that I work with are going to be way over the estate tax exemption, which means every dollar over, they're paying a 40% tax. So moving money out can be really advantageous. They also can think about using trusts. So maybe we're going to actually use some of our exemption, put investments or other high growth assets into different trusts, so all of that growth can come out of their estate. I know this video was a lot of different tax planning moves. These are all the things that we consider and think about with our clients. If you are a 7-figure income earner, business owner, then you need to be doing tax planning. Taxes are going to be the #1 expense over your lifetime, and they are controllable. You want to pay as close to zero as possible. You're obviously never going to get zero. That might mean you pay $10, $20 million of taxes over your lifetime, but you still want it to be as close to zero as it possibly can. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.